Does this work? Yeah, I think it does. Okay, good afternoon everybody, and welcome to the panelists. I will introduce them in a minute, but first let me give big compliments to the previous speaker and the sector report, which I think is quite impressive. A couple of data which I picked up and are very relevant to the discussions I'm going to have with my panelists is that we see that first Grace mentioned that there's 29.6 billion invested into AgTech annually on a global basis, whereas only 600 million is going to Africa. But later on, we heard that the most ventures, the most digital agricultural solutions are actually existing in Africa. So that seems to be a big contrast. I think everybody agrees that there's a great potential for digital agricultural services to transform agriculture and food production in Africa. But yeah, we're just getting started, and we get the impression that there's a huge gap in terms of attracting capital for this sector. Today with the panel, we're going to explore why that is. Why are some ventures hugely successful in attracting capital, where the others, which also could have a very good business model, are failing miserably? Okay, but without further ado, I'm going to introduce the panel. First, I'd like to apologize for my voice, which is letting me down a little bit. I can assure you there's no alcohol abuse there at stake, but luckily I have a very lively panel. We met for lunch, and if the panel discussion will be as lively as the lunch discussion, we're in a good place. So I'm going to introduce you to Magdalena Banasiak. She's Head of Government Development and Partnerships at Acumen. Hannah Reid, she is Program Officer, Data and Evidence at Gates Foundation. Jan-Willem van Kasteren, who's founder and CEO of eProd Solutions. And then we have Hetal Patel. He's Investment Director at Mercy Core Ventures. He's all at the other side of the stage. And last but certainly not least, Ajo Balogun. He is Group CEO of FX. I would like to ask all the panelists first to give a sort of 1 minute impression. What are you doing? Not beyond your title, but and how do you relate to the topic? So let me start here at this side, and then we work the other way. So Hannah, please go ahead.
Okay, thank you, and thanks for having me. As you said, I'm Hannah Reid. I'm a program officer on the Digital Farmer Services team at the Bill and Melinda Gates Foundation, and I primarily focus on how we can generate better data and evidence, focusing on research, intelligence reports like the one that you just saw, that can really help inform investment decision making. So that's the perspective that I'll be bringing to this conversation today.
Jan-Willem, can I invite you?
Okay, thank you very much. My name is Jan-Willem. I'm the CEO, founder of eProd Solutions. I studied agricultural economics and graduated about 26 years ago. I worked in econometric research. I worked in policy research and development in different countries for the UN. And in 2004, I started a contract farming scheme to export chili peppers. And for this company, we developed a software, a management software for ourselves, and this was commercialized 6 years ago. We sold the other company, so I have some experience successfully raising and closing at least one company. And now I'm full-time CEO of eProd Solutions, the management, supply chain management solution for agriculture.
Hello, everyone. I'm Magdalena Banasiak, and my title is a bit bit confusing, but I'm head of development partnerships, specifically around our government partnerships. For those that maybe don't know Acumen, Acumen's been in the impact investment space for the last sort of 22 years. We've been investing in agriculture for 20 years. We've invested in about 32 companies across East and West Africa, Latin America, India, and Pakistan. And we work across the capital continuum. So it was mentioned earlier about the missing middles. So we do have a specific fund that looks at kind of growth stage businesses between kind of 1 to 5 million, well, 500K to 5 million in terms of ticket size, the Acumen Resilient Agriculture Fund. But we also very much work at the early stage, which is historically where Acumen's focused on, and we do equity investment or equity type investment in early stage companies, and that's between kind of 250 to 1 million. And our capital is very patient. We normally are in companies for about 10 years, maybe 12, maybe longer in a lot of our companies, and it's very much a kind of venture building approach. We're there to help and build the company. We are very focused on impact. We have a lean data approach that is part of our due diligence, and we're very much focused on delivering impact for the bottom of the pyramid and smallholder farmers.
My name is Ayo. I'm a commodity trader. I like to introduce myself as such. I work for Afex. At Afex, what we do is to provide access to finance, access to storage, and access to markets for smallholder farmers across Africa. And what we've seen is that when you bring in these three solutions together, and you can deliver it as a bundle at the farm gates of each farmer, you're able to increase their wealth, bring them into the savings baskets, and then get them above, into the resilience basket where they start to then buy CAPEX items and increase their wealth. When I'm not doing this, I'm a perpetual fundraiser. 3 days ago, we made an investment announcement, and just as we're walking in, I was still pitching to Ethel now, so that's what I do for a living.
Hello, there we go. Hi everyone, my name is Hitul Patel. I'm Director of Investments with Mercy Corps Ventures. Mercy Corps Ventures is an early stage impact investor investing in 3 primary thematic areas of inclusive fintech, adaptive agriculture and food systems, and climate smart technologies. We invest quite early in high risk with philanthropic capital, check sizes between 50 to 500,000 in rounds that could be anywhere from 500,000 to 3 million plus. We're sometimes the first institutional in, and like Magdalena was talking about with Acumen, we also have a pretty robust post-investment platform that really helps you kind of get through that valley of death. We're quite active in ag tech, and especially on the continent, and so I really look forward to the discussion today around investments in ag tech and the gaps, but also the opportunities.
Well, thanks a lot, everyone. They're really good introductions and also a big diversity of backgrounds. But I would like to start with the entrepreneurs. We have 2 entrepreneurs, I think, who more than escaped the valley of death. They're successful, they're stable, everything okay, it seems. So I would like to hear from both of you, your personal journey. How did you get started? But also focusing on what resources did you tap into to make it to the next stage and in the end build a mature business? Ajo, can I start with you?
Yeah, thank you. So I think a week ago I made a post. I said, as an entrepreneur building particularly in agriculture in Africa, you wake up every day like you have on one hand a rocket and then on the other hand a bomb, and it depends on which gets detonated first that day. You could hit your real revenue or your real partnership, or you could go bust that same day and struggle. And it's just that's that vibe and the passion for what you do that keeps you going, and then every day you keep winning. In terms of the resources, so we're fortunate in terms of our founding at the beginning that we had sort of family offices, investors with deep pockets. It allowed us to make very expensive mistakes, but we quickly got into the commercial mode and then found product market fit within the first 2 years. But the first 2 years, we were making very expensive mistakes. But then when we ran out of cash, then we knew what we were doing, and we really started building something meaningful. But some of the very important points that helped us to scale. So first was that in first 18 months, we had a partnership. It was a project Palladium implemented, FCDO-funded project. And at that point, we understood that farmers wanted funding. We're set up as a marketplace, so we didn't even think about providing loans to farmers. But every farmer in Africa we talked to said, I want a loan to produce. I know how to farm. I just don't have the cash to buy the inputs. So we got it was called a Rolling Out of Poverty loan, and it was a repayable grant. It hedged the currency. It was £350,000 at the time, given in local currency, and for 2 years. And that was the first capital we had to prove that concept that if we could bring in a loan, a bundle to a farmer, it will take the loan, and we could prove the concept that they will repay. And when we had more volumes, more of them started to sell versus produce to feed themselves, and we could get enough volume to make the marketplace work. So that was one of the very critical points in our model. Second, somewhere around 2017, we had started 4 or 5 years into the journey. We had customers. In fact, in 2017, our 3 biggest buyers wanted to buy the business and use it, meaning that we were solving a problem. But it was then difficult to prove to our investors to give them more money because we were making a loss. In the first 6 years, we made a loss for the first 5 years. At that point, your board meetings are becoming very, very difficult. So we got a grant we went to AGRA and got a grant and said, look, the farmers were solving this big problem, but it's costing us $1.30 to earn $1. So every transaction we do, we make a loss. But there are certain tweaks that we think if we can change in the business model, first, reduce the cost of reaching them. Second, bring in a bit of efficiency in the transaction cost. Third, get to scale faster. We will be able to make a profit, and we got that funding. It was to help improve the models, and we changed that business model. And that was sort of the beginning of that turning point J-curve for us. And between 2019 to 2022 last year, we grew 250% CAGR. Last year, we were the fastest growing company in Africa. So that's sort of catalytic approach in terms of getting the right type of capital that helps you then change and pivot at various critical junctions are very important in that growth journey.
And what type of investors do you have at this moment, Ayo?
So today we've been pretty much, we bought out our founding investors also because they were too rich and had too much at stake that we couldn't take risk under their ownership. So we brought in a kind of VC investor with an infrastructure-led approach. So that plays between a VC and PE. And within over 2 years, we syndicated a management buyout, and the management team bought out our founding investors. And so today, we're in the market raising. Like I say, I'm a perpetual fundraiser, but then trying to dilute that and bring in more equity into the business to scale. What we've seen in this current round of fund, because of our scale and size, we're getting a lot of interest from like DFIs, a little less on the private equity space, but also very keen interest on the impact investor side. And we feel like our cap table will be a mix of DFIs and impact investors.
Super, thanks a lot. And then turning to Jan Willem, can you tell us your story? And which investors do you have and how your journey went?
Okay, thanks. Professional fundraiser and good talker. So as I said during the introduction, when I started the company in 2004, the other company, we had a bit of a challenge. We had limited funds. And actually, my father was a professor in economics, and he asked me, what about your business model? How are you going to run the company? And I said, well, we have so much money, but what is missing, we will just raise it. There are some grants and all that. And he looked at me, he said, no, it doesn't work like that. So we were quite successful in raising grants, but in that company, we always had a challenge. A lot of the grants, of course, you have to either pre-fund or at least cost share. Yeah, there's little really free money. So when we started in 2016 the IT company, we said, okay, let's heavily focus on the revenue model, make sure that we have a proven concept, because it doesn't make sense to start something that is basically not going to fly. So again, we didn't have so much money, but yeah, I think we had a very relevant product. One of the big challenges we had in the beginning is that, for example, we didn't have a name for the system because it was something a platform that we developed for ourselves and used by then 11 years. So we didn't have marketing tools, we didn't have any of that, but we had a very solid IT platform. So we could just focus on marketing the platform. So that is not so expensive compared to developing software. So now 6 years later, we are in 22 countries, and we were more than 30 different sectors. So there we have been quite successful. We have not been successful really so far in raising capital. On the other hand, we also have not diluted. There's 2 shareholders, me and my wife. I call it the consensus model. So we always need to agree. But the good thing is we have worked together almost 20 years. So we usually, often we agree. So we are trying to raise capital. Now there's a challenge there. I'm at an age now that I cannot take huge risks by just accepting any offer. And for an equity investor, for example, that would like to gamble with my company. So we have been playing it very safe. Everybody is looking for the unicorn. What is special about the unicorns is that there are not so many of them. So, of course, we have a very solid product, but we need to just grow steadily. We have been looking for investors, especially those that either have a lot of contacts or sometimes we have talked to companies that investors have more like a tech background. I think contacts is more important for us because that can create a lot of revenue short term, and on the IT side, we have a lot of experience there. So we are talking at the moment with different financiers. We try to raise probably debt finance, which is hopefully fits better with our plans at the moment. We don't try to raise too much. We see our competitors all raise in the tens of millions of dollars. It's amazing. We are also in an accelerator program, and often I talk to other companies. They have basically just started, no entrepreneurial experience, and they value their company at $50, $60, $100 million. So maybe we are a little bit too modest, but yeah, we try to raise, let's say, $2 million. That is also a challenge because a lot of investors, they like to invest either in a few $100,000 or in $5 million or $10 million. So that has been a bit of a struggle. We are also a little bit stubborn, so we haven't really changed our raise. So we are looking for the 2 million. We can make it 3 or so, but not 5 or 10. In the meantime, we have been profitable for the last couple of years, and we are growing very fast. The challenge for us is a little bit, we are growing so fast, and we need to expand in teams. Like now we get more specializations, of course, more admin finance people, digital media team, user experience, or designer people. So our costs are going down quite fast. And so it is important that in the next couple of months, we do raise capital, so we can continue growing like this.
Hey, thanks a lot. And a very interesting capital structure and shareholder structure, whereas the shareholders meeting can take place on the couch every night. I think there are not many. I think you have very different stories, and that makes it interesting. So I now like to shift the perspective a little bit to the investor side. And for that, I would like to go to Hetal. And I would like to ask you, Hetal, what does an investor, or sorry, an entrepreneur, an emerging entrepreneur need to do to present a compelling and attractive business case for an investor like yourself?
I mean, just tell me you're going to be a unicorn. We're done. Just joking. Please don't tell me that. I think it's slightly, I want to make the question a bit apples to apples in the sense that we are a VC impact investor. We have a very specific capital vehicle that is designed to take risk in a certain way around this word that we overuse, innovation and high risk. That does not mean that every entrepreneur probably fits our type of capital vehicle. Frankly, and I think I said this at lunch, in many ways VC should be probably no more than 10% of a country's capital stack versus PE, small cap PE, MFI, lending, debt, a bunch of other things. And so now just want to set that so everyone doesn't think I am the right person to bring your entrepreneur, because then there's mismatches and people try to make their models to fit VC when it doesn't necessarily have to be a VC model. For us, yes, we look at tech-enabled, scalable, which can mean breadth or depth or an ideal, some combination. We are flexible, so we are able to make trade-offs between, oh, this is going to have more breadth, so maybe it'll have a little bit less depth. That's just reality. Expecting both from an entrepreneur that's pre-seed or early stage is asking a lot and quite unfair. And so I think for us, I look at, is there a real self-awareness about the journey, about the business model, especially in agriculture and or climate, because it's very tough. It's not, fintech, not that fintech's easy, but they're just different challenges. And so we really look at the business model as solving something. Does it understand distribution? Understand the challenges at the last mile and a half? Understand the lessons of the last 10 years that it may be difficult to acquire customers at the last mile and a half. So how do you work through intermediaries? So really a self-awareness around your business model, around the journey and how hard it is when it comes to ag tech and climate. That's, as an early stage investor, you're leaning on a lot of that and the ability to be thoughtful about what pivots and changes are going to come, as much as I'm going to look at unit economics because those numbers are going to change as the pivots happen.
Great, thanks. Also, Acumen is an early stage investor. So Magdalena, can I ask your perspective on the same topic?
Sure. I think our priority, obviously, as an impact investor, and we are very focused on impact, and as part of our due diligence, actually, that's a key pillar of our due diligence is looking at that impact piece. And if it isn't impact aligned and it isn't looking at smallholder farmers, we won't invest. But maybe I'll just take a step back in terms of like the 20 years we've been investing in ag. I think our thesis has evolved. We started with very much looking at inputs and productivity that evolved into bundling services, and then we're looking at market linkages now, which very much resonates with what was presented today in terms of where the digital ag space is going. We have invested in pure digital plays, but to be totally honest, the 3 businesses we have invested have all been written down for various business model reasons, and it's partly to do with kind of last mile infrastructure reasons, ability to pay, and I think issues around the kind of business model. So, I think that's part of our learning, and learning from that failure is really important for us as an organization in terms of understanding kind of what are some of those business models to be investing in. Our current thesis is very much around farmer-allied intermediaries and really looking at those companies and those agribusinesses that work with smallholder farmers on a kind of range of services. But I think a key thing for us is product market fit and that needing to be right. And I think maybe one other comment I'm going to make whilst I've got the mic is about scale. So we have, and this is something that I'm really conscious of, is the fact that having also been a funder previously, we really push for scale. And scale in terms of users, or, I mean, there's a bit of debate there around kind of registered users to actual kind of people that are impacted. But just on the issue of scale, I do think that we are a bit too preoccupied with scale and numbers. And actually, I think that report was really interesting, and it proved out some of the businesses that were more profitable were actually those that were between 1,000 and 50,000 users, rather than the ones that were at that million. So I think also we need a bit of, as investors, we need a bit of a sense check. I mean, in my Acumen report, we've just registered 500 million lives that we've impacted. So we use it as investors as well. So we almost need to be a bit more accountable in terms of actually depth of impact. So it's not just about scale, it's not just about numbers, it's all about depth of impact, and that social inclusion piece, I think, is really key. And I think as an impact investor with basically philanthropic capital that we're looking at, particularly at early stage, that's where we need to be. And so that's what we will be looking at in terms of companies.
Hey, thanks a lot. Different perspectives. And I think that makes it interesting. But I also wonder, I've heard a lot of things about the entrepreneur, the business plan, the confidence. I've heard about impact. But, and maybe for that we go to Hannah, which hopefully can give a sort of address other points as well. But how about, for instance, exit perspective? Because we've heard in the earlier presentation, there hardly have been any exits. And even if you're an early stage investor, at some point in time you want to get out. And how about profitability? And how far away is that profitability? Just a couple of points. But Hannah, please feel free to address anything you want on this topic.
Well, I know impact has already been touched on, but I'm going to emphasize it again because we are a philanthropic organization, and we always say impact first. And so when we are looking at our work and where we can provide support, philanthropic funds, we're really thinking about solutions and opportunities that will benefit small-scale producers, both crop and livestock producers, and we're very focused on that impact case. So I think I will just emphasize that piece. And I think that's important, especially in this context, because a lot of the funding that's coming in is coming in from donors and sub-commercial funders that are focused on impact, especially in this market. We worked with ISF on an analysis, and I think it was about 88% of funding right now is coming from donors and those sub-commercial funders who are really focused on that. And that's compared to only about 15% of funding in India. So I think the conversation around impact is justified here. And for us, you know, we're also very interested and focused on the inclusion aspect. We know that women make up about 70% of the labor in agriculture, but we saw from that report that there's still only about 26% of women that are being reached by solutions. And so that's a really important aspect that I think we need to continue to focus on. Or I think there was a comment about, you know, kind of fit. If the market, if we're really talking about women as primary users of these solutions, how well are the solutions actually meeting their needs? That's going to require some deeper market analysis and likely additional investment beyond what the innovators themselves can do, but I don't think we can lose sight of that. And then the other thing I just wanted to mention related to impact is around climate. We had a really great climate session that I attended earlier today around kind of introducing climate financing. And as we think about impact opportunities, you know, agriculture is significantly impacted by climate change and at the same time contributing to greenhouse gas emissions. But there's more and more funding that is becoming available for ag tech solutions, climate tech solutions, digital ag, however we want to classify them, to really tap into those resources. And I think there's more opportunities to really frame the business case with the climate lens.
Maybe going back to Hetal. How do you look at exit perspectives of the investments that you make?
Well, I think where we start is we are an impact investor, so it's impact first. We have our investment memos have a very clear route to impact, theory of change, et cetera. And then we also bring a commercial discipline, because I think that lens, one, makes us responsible to the money we've taken, and to make sure we try to invest it responsibly, but also hopefully make our analysis fit where we think the growth will be and actually a sustainable business model would be. And then that is where then you can lead to exit. So this ties to even the title of this panel, which is Driving Investments. I think part of it is we need to have a broader conversation with a diverse amount of stakeholders, government, banks, other money, commercial, non-commercial money, on the capital stack. I think if we don't get mid-size and other size PE in, then we're really limiting where exits can come from. I saw in the report they mentioned, the most exits are from M&A besides IPOs, but actually that's good. I mean, I don't know how we expect IPO exits in a lot of emerging markets when we don't have the robust capital markets. And if you really study IPO exits, it takes 4 stages, even from Silicon Valley, angel, buddy investing, all the way to IPO and we don't have those steps here. So I think to be realistic about what we have, how do you build the capital stack? Who should be helping build that, right? There's a good amount of money that sits. A lot of them may not be VC friendly, in the sense that they may not want to do VC, that high risk, but they should want to do maybe business that get profitable by year 2 or 3 and want to get dividends out. And so I don't know how that conversation happens yet. I'm definitely probably not the right person. I'm not in the right rooms, but there are people who are getting into those rooms, I think, to unlock a different variety of capital stack. Because I think someone here said that India is getting more. I think part of it is because local Indian money got into the business of buying an M&A. It wasn't just foreign money. I think if that's dependent, then it is going to be around DFIs and impact, and they were constrained on exits. But I mean, exits is a metric of growth. So I would rather think about it in terms of growth and what are the resources needed for growth versus just exits. So it's not about just packaging to get out, but as much as what are we building that actually sustained? Because then people want to invest in it.
I think that's a very valid perspective, because it's not about IPOing. Indeed, M&A is just as good, and it's maybe even better to build businesses that throw off cash for their investors and create impact at the same time. Adjo, I'm very curious, because you're very far ahead. You're appealing to DFIs as well, which, as we know, are a very demanding crowd. Also, wanting to invest big amounts and want to combine both impact, but also, in my experience, are quite return-oriented. So my specific question to you is, how did you appeal to them? What resonated most with them? Was that your impact story? Was it the scale? Was it, we're bigging here, we're building a really big company and we can exit that at 2-3 times money? What did the trick?
So I think the first hook for most of them was the impacts at scale. So the fact that, it was transformative, it was very visual when you meet our clients. In fact, our best pitches are the ones where we say, after the first pitch deck, we try to lure them to say, look, come visit, let's take a look, let's go to the farm, and then we come back, and then from there we write your investments thesis to your IC together. Those are almost all the deals that we've been able to pull further along. Now, don't get it wrong. For most of them, 2 years after that visit, we're still in the room. But what we've been able to do was to hook them with that impact scale and the moat that this business actually has a big moat. You're solving a big problem, and that is a leader for you to remain relevant for a long period of time. So that's the first pillar I see. The second is that the corporate governance is extremely important for them. So it's your ethical values, your internal organizational structure, your governance mechanism. You just that, and that's it's, to be honest, it's a rather expensive thing to build for that, because it's, how you work is how you're structured, is how you recruit, is what culture you're building. And most of the time when a startup is bootstrapping, you go, in that pirate mode, and you're like, it's a text message approval, And if you go and you don't get to a point where you go from pirates to Navy, you would have problem fundraising for your growth phase. So that point where you go pirates, you lead, you get product market fit, you get to revenue, you raise, you must then get to that point where you iterate and become Navy, and then put structures, put teams, put heads, have a distributed leadership structure in place. I think that's, so the last one is, revenue is the cheapest investment. Your revenue is the cheapest form of capital. There's nothing that beats that. If you, a lot of us founders and investors, unfortunately, raise capital to fund our lifestyle rather than raise capital to really grow the business. But when you focus on getting revenue, growing the business with revenue, paying salaries, for 3 years in a row, our magic number was 16 million naira. Our payroll was 13 million naira. To keep the lights on was 1.5 million. That got us to 14.5. To travel was another 500,000. So every time, you wanted to get to 16 million by day 14, 15, if we're not at 16 million naira by day 20, then it was a problem for that month. And so, how do you get to that revenue to fund the business and fund the growth? That's the best one. When you get that and you have a very decent cap table, it's easy to get institutional capital. When your cap table is already crowded, before you get to like 5-6 million or your revenue is substantial, then the problem is some of those investors start to look for a way out when you're in your tough period, because growth is hard and difficult, and that sort of destroys value rather than help to create it.
Yeah, I can imagine. But also to get to that level where you really generate revenues, have a track record, which is important for the FIs, you need parties like Acumen and like Mercy Corps Ventures, right? So probably that's where the interface is. And maybe also look at the entrepreneurs who are not that successful, who are struggling, who are plateauing, stuck. Maybe, Hannah, I can ask you, did maybe BMGF also has research into that? Which are the entrepreneurs, the ventures, that have relevance from an impact perspective, but don't get over the hurdle?
Yeah, that's a really great question. I think about it, well, I think from a couple of different perspectives. There are, even in the report, I think we saw, 77% of companies are unfunded right now. And there are many companies that are doing really amazing work. And I think yesterday in several of the panels, we heard these stories of impact, that things are happening on the ground. But they haven't reached the scale or maybe attracted the level of investment yet. So they're not really visible to some of the bigger investors. And that's an area that recently we've been kind of digging into a little bit further, of trying to better understand how lack of visibility actually could be contributing to this funding gap, especially for some of these smaller and earlier stage companies. So I think that's one thing, is like creating ways to highlight those companies' platforms where they can become visible. Another piece of that we're also finding is relates back to the business model, is that clarity of the value prop. So I think sometimes it also comes back to the packaging of the message. Earlier we saw ID Insights, data, all of that is super helpful to, again, go back to some of these investors, packaging, the pitch. I think that's where some of these accelerators and investment readiness programs can come in to really maybe help companies kind of overcome that hurdle. And then relatedly, another piece that I was talking to a colleague about recently was just the importance of getting really candid feedback. Oftentimes, we don't have enough time, or everybody's busy, and really there's a lot of like coaching that's needed, I would say, and opportunities to get that sort of candid feedback, whether it's in the idea itself, brainstorming through that to say, does that make sense? Have you thought through these questions? Maybe like your father was alluding to, of just, there's a lot of things that need to be kind of considered. So having those sort of thought partners, but also people that can give you really clear feedback on the way that you're presenting your information. I think that sort of candid feedback will really help kind of fill some of those gaps.
Yeah, I can see that as well. But at the same time, you also see that investors in particular from Europe or the US or DFIs, they focus on a certain segment of the market. It's very visible. If you look at it like a pyramid, everybody focuses at the top of the pyramid, resulting in that a couple of very good businesses get lots of money at rates or at yields which are far below the risk, whereas others, which are a little bit, you call them second tier or third tier, don't get any or at very high cost. So Magdalena, maybe you have a perspective on this.
Actually, what you've just said really resonates. In my previous role, I used to sit on a lot of challenge funds and a lot of investment committees, and I would see the same companies again and again being funded by the same funders or a range of funders, but would be very good at raising capital. And that was no fault of their own. As we had a roundtable actually with some of our entrepreneurs and investors at AGRF, and basically entrepreneurs said, we need the capital, we will take what capital is available. So we will take grants or we will take debt. And often they take on too much debt. And I think that was particularly the case during COVID. We've got one company that, as a result of climate change, their supply chain is completely being halted, and they've taken on more debt. So now we're looking at kind of restructuring that capital stack. Anyway, I've kind of diverged, but coming back to your point around kind of visibility of pipeline, I think that's really key. As Acumen, we have teams in country, in market, but that's still in terms of getting that visibility. And what we're finding, particularly as we focus on more kind of local entrepreneurs, that actually the accelerators aren't really delivering for us in terms of, from an investment perspective, they're not ready for our investment committee to get them over the line. So we're actually having to go in and provide pre-investment support, set up the governance structures, in some cases even do registration of companies, bring in a fractional CFO. Look at a range of really hands-on TA that we're providing to the companies to get them over the line. And in some cases, actually pivot some of their business model. But as long as they've got that line of sight around profitability and revenue, but also impact, then we're willing to be patient and work with them on that journey. But I completely agree that getting visibility on more on the innovations that are out there would be really key.
And let's now also take other factors into account and also other players. And then you can think about NGOs, for instance, philanthropy, sector organizations. What role can they play? Maybe I can ask that question to Jan Willem.
Yeah, I think it's interesting because there's a lot of investment which is not purely commercial, like you mentioned AGRF and ACF before. So there's a lot of grant funding, which is, in my opinion, very distorting. And it kills often the entrepreneurial spirit. So we have let's say we have about 200 clients in those 22 countries, and they are pharma cooperatives, traders, food processors. And a lot of them, they just, their core business is just looking for grant funding. And that's a real challenge. So in our case, you could say that's an opportunity because risk-free, those companies can often can get a license for eProd for 1 year paid for by an NGO, for example. But what is the point for us? You cannot try to offer it the software as affordable as possible and then have a very low retention with certain type of clients. So that is not helping that company, and it's not helping us. So it's a real challenge. What is interesting for us as an opportunity, that there is more and more need for quality data. So NGOs, for example, that really have the technical expertise and the long-term approach with private sector, they can, if they offer a license fee, but they have also other activities, technical assistance, and maybe link those to financial institutions, investors, work with them in many areas, then for us, the retention chance is much higher, but also we can offer a lot of data exchange. If the companies agree, there's all these environmental, social, governance indicators, basically hundreds of variables in our system that we can make available, as long as everybody agrees on that. And then if you have multiple, let's say you're an NGO, and you work with multiple private sector companies in multiple countries, we can create structures for that, where everybody can have access to this data. And there is no cost to that, so it's very interesting for example, for the NGO to get quality data at not even the doorstep, but basically into their computer directly live. You get high quality data. It's very, very affordable. So that is interesting. But it is, for me, if I could choose, I would prefer just to do business to business. Commercial companies, straightforward. It's quite often we have companies that say, okay, now, thank you very much. We really like the product. Who is going to pay the license next year? Then of course, then the story stops. Because we know, even if we would, sometimes we give a discount, of course, but yeah, that's just not the way it should work.
Well, I think it's a very healthy viewpoint, and I think many other entrepreneurs would disagree because they enjoy the grant funding. But I think this is a really great approach. And of course, I have to ask Hannah the same question about role of NGOs, philanthropy. What role can they fulfill?
Yeah, thanks. And I love what you said about the data exchange. I think that's a real opportunity. And one of the roles that I think that philanthropies in particular can play, or like donors like ourselves, are really supporting governments to develop that infrastructure for data exchange, farmer registries, other digital public infrastructure, and other infrastructure overall that would really allow for, as you said, grants can really distort the market. And so as we're thinking about our investments, we're really thinking through what can we do to strengthen the ecosystem. Okay, if it's investing in that sort of digital public goods or data sets that can be foundational, that everyone can kind of leverage. But then, of course, we need to be thinking through the governance strategies, what are the policies for protecting farmer data, because that's critically important. So that you can overall reduce the cost for entrepreneurs and innovators to leverage those assets to build their value-add products. So that's absolutely one place where we see a real opportunity. And then the other, of course, is strengthening the policy environment and helping support, again, working with governments and private sector as well to think through strategies, digital strategies, investment plans that can really strengthen the ecosystem.
Hey, great, thanks a lot, Hannah. And let's now go a little bit further in the life cycle of an emerging company, promising company. Things don't exactly go as planned. Not necessarily very bad, but you hit the ceiling. Growth doesn't go as fast. Maybe there's an investor who wants to exit at a stage which is really too early, starts exercising pressure at the entrepreneur. We have two entrepreneurs here. One for sure didn't have that experience because it's a very closed circle of investors. But maybe, Ajo, you have a long history in dealing with investors. How did that go? And were there also moments where you didn't meet your projections and they said, well, maybe it's not that great, or maybe we should exit? Or, can you elaborate on that?
No, it's, especially, and I say, I start with this side because there's the blood is rushing through my head as I think through the memory, particularly in this part of the continent. So when we started and we were setting out the business, we had a mandate to solve a problem. How can you get capital in the hands of the smallest unit of business in Africa, which is the smallholder farmer? How can you solve that, using an exchange and marketplace approach? We were funded from a few family offices. We had like 3 billionaires as investors, and we rented the highest office in Kigali at the time, literally. But we burnt a lot of cash in the early days, and then we got into the investment phase, and the guys were like, okay, fine, Kai, what are you guys really doing? What is the moat? Where is the revenue? How are you just building out costs? Why are you paying? We use 70% of our first capital raise to buy a piece of technology that we earn zero revenue from. So those kind of mistakes. And we got back into that, okay, how can we solve this problem? It wasn't about listening to the consultant. It was about going to the farmer and asking what services do you need, and how do we build a business from that? So we had that first turnaround. But at that turnaround, sort of 2015, when we now got what we were doing, the investors were tired, and then they were like, no more cash, go get revenue. And that was the first phase where we had that big, restructuring of the, when we moved from the sort of family office side to the real investor guys, and we started talking, raising capital, equity, and things like that. Now, as we started to build out, I talked about the point of inflection. But then it was also the point where a number of our founders said they wanted to exit the business. And, this was like 6-7 years of loss making, and, there was no point staying in. And we saw how to get to revenue and how to make profit. But we also did not have the mandate to take the kind of risk that would turn around the business. So it meant that we needed to change, who was our investors to be successful. And that was a very difficult process. It's still, part of then finding the right person. And it was a long journey. It was a 2-year process. I remember January 2019, I'd written to our investors to say, these are the business is likely going to run out of cash by June. We're likely going to not be able to pay salaries by September, October. I think that we should start to wind down the business, and these are the 4 ways that we could wind it down that wouldn't be messy. So, I sent that, and I thought that I'll get a response, but they didn't even care enough to respond to my email. They were like, you're dead. Why are you trying to plan your funeral? But with that in mind, we started, we were like, look, we understand how to build this. We need new investors. If we can get cash with 18 months, and we get a commitment for these investors that if we pay them, they will leave, we will make this around. And we made it happen. It was 2 years. Now, I said we announced a $26.5 million investment by British International Investment 3 days ago to invest in Nigeria, Uganda, and Kenya. But that's, again, 2 years. 2 years, 700 questions, probably 45 calls, 30 of which are ESAP, ESG related. Very hard, long, grinding process to get to that point of, okay, we have a deal. And then, to get the cash is another. I was talking to my colleagues, and they have 115 CPs, items that we have to go through. 115 documents we have to send it in to be able to draw the first dollar of cash. So this is a long process. I think part of that is also how do you build a team that can speak the language, articulate the points, present it in a way that makes sense. And that's the hard part, because sometimes the people that build the business are not necessarily the guys that sell it to investors. I remember on one round with Matt here in the room, and we're speaking, and we're talking about some of our technology and we've built, and it was like, okay, you just need to change your taxonomy. Don't call it this. Call it ERP. Don't call it this. Change the name and call it this. That's what people want to hear. And I was like, really? That's just that change? And some of those things are part of what you have to do. But sometimes as founders, we understand the business. We're very passionate about it. We know how to make money out of it, but we don't necessarily speak the same language that the investors want to hear. So that framing But in framing it, you also want to be careful that you're not promising what you cannot deliver on. Because I found out that there was VCs I would never pitch FX to, because every time I spoke, even when it started to make sense and we could tweak the languages, I knew that I would have a boardroom problem if I raised that capital. So, there was that mismatch in terms of timing and risk appetite.
Okay, these are very valuable lessons and quite a journey. Maybe also, Hetal, one of your investees does not meet your expectations, runs out of cash, or is just not, the business model doesn't really seem to work out. How do you deal with that?
The last few questions have been multiple questions in there. At a certain point, that's your job as an investor. So I don't want to overcomplicate or make this some boogeyman. Pardon my American colloquialisms, but this is my job as an investor. I may have made investments where either the business model wasn't what I thought it could become, fine. The entrepreneur may have not taken the journey that would have made it successful, or a variety of other things that are externalities like COVID-19 or something else, right? And at a certain point, then you help. If the entrepreneur is communicative and really early on gets to you where there's enough cash left that you can try to help, bring in some grants, which I disagree with, that grants should not disappear, but I'll address that in a second. Especially if it's a strong model and needs some breathing room, i.e. runway, find other investors. You get in there, right? And you try to find other co-investors. There are maybe co-investors on the cap table who are willing to do that work with you. You think about downsizing. These are all the tools and techniques you have to use. But in the end, I don't think of that as difficult. That is part of my job if I'm going to invest in IO and say we're going to do this journey together, right? And so I think that's and if you're entrepreneurs, ask that. Try to suss that out when you're taking money, because that's going to be as important as the check. Because again, this is not that easy. And in terms of fails or pushing people for exits, I'm not sure that question is that relevant. It may sound a little ignorant of me, but we just don't have that much capital so we can push people for exits. Oh, you're performing so well, so there's a bunch of people knocking on your door, so sell to them so I can get my money back. How many, you know what I mean? That doesn't happen that much. I wish it did, that I can get money out and I can show my LPs, but it doesn't. I think the bigger challenge is, how do we build something? What are the challenges? What are my externality challenges? What is my digital infrastructure challenges, right? Last mile data silos. How do we share the data? So you can have more complex business models versus a lot of my AgTech business models focusing on solving KYC for the farmers and last mile information, right? And earlier there was a Rabobank presentation around is that transferable, where you're using local community groups and others and NGOs to be able to help data and validation and verification. Can that help solve last mile digital? So I think there are other systemic challenges versus pushing for exits. Quite frankly, I think that would be an easy problem that both an entrepreneur and an investor would probably wouldn't mind.
Yeah, thanks. Yeah, let's say the systemic part, of course, is also important. So let's get back to where we started, because we said, okay, there's a lot of money going into digital solutions for agriculture, but only a very small part goes into Africa. So if we take a sort of practical approach, not super high level but what would be the interventions, or what could be done more in order to really up that 600 million? Maybe Magdalena, you have an idea about that?
Yeah, I think it's on multiple levels. As I said earlier, this is very much from an Acumen perspective, is the fact that we work across that capital continuum. So I think part of our role as impact investors, and hopefully Hetal agrees with this, is to bring in others. So it's not just about our capital. We may be the first institutional investor in a company, but it's also our role to bring in others, whether it's other equity investors or other debt or grant funding, if that's appropriate. So I think that's one of the things in terms of increasing. I do think we're also looking at tackling that through kind of our Acumen Capital Partners, through some of our debt and equity funds that are for-profit, that are still concessional, where we're bringing in that first loss layer through these blended finance facilities with the Green Climate Fund. So that's another mechanism to address some of that missing middle that was highlighted earlier around kind of those ticket sizes that aren't quite your DFI that FX has been successful in getting, but on that pathway to where FX is today. And then I think the other bit of that spectrum that I think is missing, and often we kind of forget about because it's not necessarily giving us the big numbers in terms of leverage and in terms of scale, is the early stage, is that pre-investment support that's required, is really building out the ecosystem. And I think, and that's not just about us, it's us partnering with others, with venture builders, with others in the space, with NGOs, for instance, in terms of working with cooperatives. I think there's a kind of depth of impact we can look at there. And then identifying kind of some of those innovations. I mean, I think the role of philanthropic capital is to take risk. We should be in there actually taking some of those risks around some of these innovative business models or innovations and really trying to prove them out in the market. So that's kind of where I see that, where I think we need funding across and investment across that whole spectrum to really build out the ecosystem. I don't think it's a one solution, a one silver bullet, unfortunately. I think we probably need to intervene at all of those different areas. I think one other thing that came out of the round table we had with investors and entrepreneurs was the difficulty that a lot of entrepreneurs have in terms of understanding what capital's where and making linkages. And I think that's probably another responsibility for us as as investors, is to help navigate that ecosystem of where different types of capital and to bring in others. Because it is, I mean, it's bloody difficult. It's hard work. Trying to apply for funding, you're managing your startup, you know, trying to keep things afloat, taking on maybe more debt than you need, and then having to restructure that. You've got climate shocks, you've got COVID, you've then got the Ukraine crisis, and you're managing all of this. So I don't underestimate the risks that you take as entrepreneurs and putting yourself on the line. And I think the role for philanthropy and the role of impact investors is to stand by you in that.
Yeah, that resonates a lot. Thanks for that. And we have to round off, but not before giving Hannah the floor to share her thoughts on this topic. You know, what can we do more in order to increase capital flows into digital solutions in Africa?
I thought that was a great place to leave it.
Yeah, it was great, but yeah, I mean, maybe
you summed it up so
putting you at the spot, but I think you can handle.
Yeah, I really love that, and I guess what was just coming to mind as you were describing that, which is the theme of this convening is partnership. And what I really loved in this conversation throughout was talking about this capital stack, thinking about the partnerships that are required to support entrepreneurs to become successful. And that really is like different types of resources coming together, whether those are financial resources or, you know, the convenings or networks. And I guess that's what really came home for me in this conversation, was that, you know, working together is really what's going to, you know, drive more resources into this space.
Well, I think these are great closing remarks. Thanks, Magdalena and Hannah. Maybe there's time for some questions. What do you think, Grace? Two questions.
Hi, that was a great panel discussion. I'm Shan Kinyanjui. I'm an agripreneur and an agro-processor, so it was a great conversation. My question is more around some of the stats we have heard during this conference. So we talk about, you know, 70% of the agricultural backbone are women. Yet this report that came just before you jumped on the stage talked about 7% of women get access to finance. So I really would like you guys, especially the institutions, to address that fact. Thank you.
So, and I'm going to address this from a point of, so we provide loans to farmers. We provide about 200,000 loans across our markets we operate in. And we try to reach 35% inclusion, with about 28% of our farmers direct beneficiary. Now, what we see is that, so first is there are quite a number of legacy issues, cultural, religious things that you have to mind, and you have to understand the unintended consequences of that capital you're doing and how you want to approach it. So, so it's, for me, and also being, African and, born on a farm, from a farmer father, I always respect those cultural norms, but then innovate around them. So, for instance, we're designing a program, and it's about bringing solar-powered pumps to farmers that plant rice, because in Nigeria, cost of fuel moved from 150 naira per liter to 600 naira per liter. And this is the first irrigation season that is coming after that price jump. So, the farmer is just going to say, I used to spend this as part of my production cost, now this. So we're bringing it, but then we want to tie it on. But we also know that, for almost every area that produces rice farms, there's a 2-month window that after the harvests that you do horticulture, mostly peppers. And most of that time, because of how labor intensive it is, the women farm it. So we're bundling a solution together for women pepper solution along with the solar pumps for rice farmers. And then it's almost like an household package, but we are reaching them. So the innovation is around how do we design the product to be able to reach them. Sometimes what we've seen is that even when what they do is that the women cultivate the smaller farm closer to the home, and that provides food for the house. While the farmer, the men cultivates the farm that is further out, which is then used to get the cash flow, for the family, for himself. The question then is that we also try to, navigate over time is how can we then find, since the farmers are, the women farmers are closer home, how can we bring them together in a different structure than our standard modular structure that we roll out for the men? One of the things we found out that while the men is expected to repay in grains, we had the women coming back and they were repaying in cash, but then they will pay even faster than the men will do. And we're like, yeah, this is fantastic. We love you guys. We want to scale it. But we want grains. We're in the business of grains. We're not a microfinance bank. We don't want cash. We found out that the women don't monocrop because for them, it's like, I need to grow a little bit of pepper, a little bit of this, a little bit of this. They also prefer shorter cycled products. So they do horticulture and different things. So they can't grow maize. When I try to force them to grow maize, then I push them further away from home. I affect so many other things. So the question is, how can you then create a product that works for them to be able to include more of them? And we continue to struggle with this. But I think our point is that let's, respect some of these cultural norms, but let's be very innovative on the product creation side and the channel side.